Welcome back to the deep dive. Today, we're looking at a stack of financial texts, but we're trying to get past that old cliche that, debt is bad.
In the markets, it's just a product.
Exactly. It's a tradable asset. When you buy a corporate bond, you're not just stashing money away.
Sure.
You're literally becoming the bank.
And you're stepping into a market that's way more volatile than people think. So our mission here is to really decode the language of lending, specifically corporate bonds.
We want to understand why a contract that promises a fixed income can, jump all over the place in value.
Right.
I mean, we all know the basic parts of a bond. You've got par value, that's usually the standard $1,000 face value.
The amount you get back at the end.
Then the coupon rate, and of course the maturity date. But for this deep dive, we need to see them less as definitions and more as levers. Levers that can really distort the price.
That's the key. Because the second that bond is issued, it's out in the wild. And the biggest force acting on it is the market interest rate. This brings us to the teeter-totter effect.
The classic inverse relationship. So let's say I'm holding a bond paying a 5% coupon. Then the Fed hikes rates and new bonds are suddenly paying out 6%. My bond is now, it's basically obsolete inventory.
And nobody pays full price for obsolete inventory. If you want to sell that 5% bond, you have to discount it.
You have to drop the price below par.
Exactly. You drop it until its actual yield to a new buyer matches that new 6% market standards. That's why rising rates can just crush the value of existing bonds.
But the flip side of that's the trader's delight, right? If rates fall to, say, 4%.
Then your old 5% coupon is a gold mine. It's a high-yield asset, and that pushes its price to a premium.
Investors will bid the price up way past $1,000 just to get their hands on that higher cash flow.
But pricing is only half the story. The
Sure.
real gotchas are buried in the fine print, the power dynamic.
The call and put provisions.
Yes, this is where the contract decides who's really in control.
So a call provision is the issuer's weapon. If rates drop, the company doesn't want to keep paying you that high interest from their old bond.
Of course not. They want to refinance, just like with a mortgage. So they call the bond back, they pay you your principal, and then go issue new, cheaper debt.
Which is a disaster for you, the investor. You lose that great income stream at the exact moment. You can't replace it with anything as good.
That's why you have to look for call protection, a blackout period where they can't call it, or a call premium, where they at least have to pay you extra to sort of break the lease early.
And then you have the investor's shield, the put provision.
Right. This flips the power. If rates spike, you can force the issuer to buy the bond back from you at par value.
So you can take your money and go reinvest it at the new higher rates.
It all creates a trade-off in the yield you're offered. Callable bonds, the risky ones, they usually have to pay you a little more interest.
To compensate you for the risk they might, fire you as their lender.
And puttable bonds pay less because you, the investor, are paying for the safety of having that escape hatch.
Okay, so let's get to the most interesting one, the transformer asset. The convertible bond.
These are fascinating. This is where debt can literally shapeshift into equity.
It completely breaks the wall between being a creditor and being an owner.
You hold a bond, you get your coupon payments, but you also hold an option to swap it for a set number of the company's shares.
And that creates a very specific arbitrage opportunity. The research had this great Widget Inc. example. A bond is trading at a discount, say for $850. The conversion price is set at $40 a share, so your one bond can become 25 shares of stock.
But here's the fun part. Suppose the company does well, and the stock price rallies to $35.
The math gets interesting. 25 shares at $35 each is suddenly worth $875.
But the bond is still trading for $850.
It's a glitch in the matrix.
It is. A smart trader buys the bond for $850. Tom immediately converts it into stock worth $875 and sells the shares. You capture that spread instantly.
It really changes the whole psychology of being a bond investor, doesn't it? You start as this conservative lender. You want stability. You just want them to be able to pay the coupon.
But as soon as that stock price gets close to your conversion point, you switch teams.
Completely. Suddenly you stop caring about stability and you start rooting for volatility. You want the stock to shoot for the moon so you can convert and cash in.
It totally blurs the line between a safe investment and a speculative one.
So here's a thought to leave everyone with. If you own a convertible bond, are you actually a lender? Or are you just a gambler hedging your bets until the jackpot hits?
It definitely complicates what's in your portfolio, that's for sure.
Take a look at your own holdings and see where the power really lies. Thanks for listening.